Hello and welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst.
I'm Brian Leverage, still.
That's true. And this is the beginning of part 2 of our question and answer session. It got a little long, so we broke it up into 2 parts, and we hope you enjoy.
Yep.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour our old fashioned real estate advice.
Episode 15.
Coty's local in Chattanooga here. I don't know if I mentioned that. So he has a third question, and this is his final question. I like this question, by the way, so I might answer it myself. Is that okay with you?
So should I ask it, or do you want to ask it?
No, I'll ask it. I'll ask it to myself. Hi, Jeff. My name is Coty. I would like to know, what do you think about before retiring from your full-time job to invest full-time? For example, how much money do you need, and how do you think about insurance costs, stuff like that? And the answer is yes, I do think about insurance costs. And I think the amount of money you need it depends. So there you go. That's my answer. No, so what I would do if I were thinking about leaving my job, and this is actually what I did do when I was thinking about leaving my job, is I thought about what my personal lifestyle expenditures were at the minimum, right? And then I went, okay, let's just say I needed $10,000 a month just to make up a number. So if I need $10,000,
does that include your art purchases?
No, it does not actually. But I have some great art, so It's okay. So if I needed $10,000 a month, and I knew that I was making, say, $200 per unit of cash flow after all expenses, then I just simply took the $10,000 and I divided it by $200 per unit, and I knew that I needed that number of units. And of course, it's different for everyone, right? Mm-hmm. Because some people they need $10,000 a month and they make $800 a unit because they have free and clear assets, and then they might only need 12 or 15 paid off houses and they're there. So it's really dependent on what your personal budget is, and then also how much cash flow you get from your assets.
Right. Yeah.
So I do like that question, but again, that's one that when we meet for that old fashioned, we'll have to talk about it. So we have a question from Bangor, Maine, actually.
That looks like a really long one.
No, this is the short one.
Okay.
The long one is from Grand Haven. We'll get to that in a minute. And that will be our last question. So we have 2 questions remaining. This is Paul in Bangor, Maine. He says, and this is a 2-part question also, is it better to flip homes or do rentals?
Both.
Okay, and then related to that, which is better, vacation rentals or long-term rentals?
Depends on your tolerance and patience. So let me answer the first question.
Sure.
Okay, so in my opinion, most investors should take a dual approach to invest in. You have your long-term gains and you have your short-term gains. Your short-term gains are what should fuel your long-term acquisitions. So flipping properties, whether it be wholesaling or rehabbing and selling, that's a short-term pop, right? Usually it's a couple weeks, maybe a couple months, depending on which one you're doing, and it's going to yield a certain return, and you take that money and you can reinvest that capital into other assets, longer-term holds. And while I'm not dispensing tax advice, if you're going to take that dual approach, what one should do is keep those 2 approaches sheltered entirely from the other. So if you have, say, 2 LLCs, one's a short-term LLC for flipping and turning over properties, or maybe an S corp. Again, talk to your tax accountant. And the other is a long-term, approach, and you keep those baskets separated from each other.
All right. Well, let me. I've got 2 thoughts on that. One, that is the approach that we used.
Yes.
We did a lot of flipping. I think you've done this as well, but we've done a lot of flipping. And when we were flipping about 2 houses and buying 1 long-term hold with the profits, and we ended up with a pretty large portfolio of single-family homes that were free and clear as a result of that. It's an excellent way to build your portfolio, but I think that you're wrong about one thing. I think that it's not true that most investors should do both. I think most investors should do long-term buy and holds for sure. I think everyone should do that. But I do think that if you have a really high-paying W-2 job, you can just convert your income from that into long-term buy and holds and skip the flipping phase. Because I think the flipping thing is a way to generate income.
It's a fair point.
It's essentially a job. So if you have a high-paying W-2 job already, I'm not sure that you need to be doing flipping.
Okay, but here's where I'm going to tell you, you might be a little wrong.
I could be. It's possible.
I'm pretty sure you are.
Oh,
so,
I know you're wrong, so it's okay.
So, what percentage of our audience, not just our audience, but investors in general, already have a high-paying W-2 job?
I would say it's a very high percentage of investors and a small percentage of our audience.
But everybody starts, those that make the transition into investors, right? You know, you're starting out from generally a smaller platform.
How about we agree to disagree on this? I'm going to say there is no correct answer to this because
except mine.
Right. So some people don't need to do the flipping stuff. Some people do.
And that's true. And again,
and
where Jeff is right, although he doesn't see it this way, is that you have limited time. That's your biggest resource, by the way. It's not money. It's not anything else. It's time. Okay, so if you don't have the time, you need to have contractors and other people whose time you can leverage, right?
Right, like leverage is time.
And
we
so,
time.
Going off on that, that's, you're focusing on that element of things. For instance, I flipped properties in Chattanooga while I was still living in Los Angeles before moving here 6.5 years
Well,
ago.
I mean, in fairness, I've never flipped properties in Chattanooga the whole time I've lived here,
Right.
but I have flipped some in Detroit during that time, so I do understand that. And I'm not saying you're wrong about the fact that it is a good strategy. I'm just saying it's not the only strategy.
It's not.
And some people we know only flip houses, and they're just about cash flow, and they put the money that they make from that into growing their flipping business, or maybe even into the stock market or something. Everyone's personal investing strategy is different,
Sure.
But I think you and I would agree on this, that if you're not investing in real estate, you should be, and the long-term buy and holds are the most predictable long-term cash flow.
We agree 100% there.
All right, we have one question remaining, and it's the long one.
And it's a doozy.
Well, in fairness, there's
Is there
a
a Cliff's Notes? Because I'm looking at that. It's about 10 lines.
It is. It's actually 12. I counted. So there's a few editorial comments in here, which I'm going to skip over.
Okay.
So this question is from John in Grand Haven, Michigan.
Okay.
All right. So he says he's a partial fan of Dave Ramsey. Not sure what that means. He says, in fact, he's actually taught the Financial Peace University course. He knows that Dave means well, but he thinks that Dave has some baggage from debt when he over-leveraged and personally filed bankruptcy. He says, obviously, if you do not have enough leverage, or if you have too much leverage, it can be a problem. But he thinks that Dave's view is, this is pretty hardcore actually, distrusting of human nature. And
Dave
he thinks,
sounds like me, actually.
yeah. Fair enough. Anyway, he finds that very zero-sum. So that's his preface. Okay, so the question is actually, how do your views of the proper use of leverage differ from Dave Ramsey? In particular, he notes that Dave Ramsey doesn't like any leverage, or if he does have leverage, it's only your personal home, and then maybe 20% loan to value.
So first off, it sounds like Dave Ramsey would never like me, period. Because
do you know who Dave
my last
Ramsey
name's Leverage.
Do you know who Dave Ramsey is? Okay, all right.
I do.
Very good.
So we're not going to retell the whole Dave Ramsey story here. I don't know Dave. I've never met him.
He's local, though. He's up in Nashville.
He's up in Nashville. Yes, he is.
Yeah.
So I think that, to each their own, right? Everybody has an investing philosophy. And what Dave mostly advocates is a debt-free lifestyle. And I get where he's coming from on that. I think there are responsible uses of leverage, and I think there are irresponsible uses of leverage. And a couple of examples of both would be, responsible uses would be buying investment properties. We are still in a historically low interest rate environment, and leverage can magnify your returns. Now, you can run onto the rocks by being irresponsible about that, by not doing proper deal analysis, etc. However, irresponsible debt would be things like buying more home than you can afford,
like buying art on a credit card.
or cars, or going on cruises and getting artwork and financing that.
Yeah.
Things of that nature. But again, to each their own. So I look at it, and I don't think you'll disagree with me here, is that at the end of the day, if you have to save up enough money, however you achieve those savings in the first place, buying something, an asset free and clear, your ROI is significantly lower than if you leveraged it at, say, an 80% lender to 20% borrower ratio.
And we did a video on that,
Yeah.
and we'll put that in the show notes. In fact, I'm gonna put it right up above us here. So I agree with you on this, by the way. So I think Dave Ramsey is 100% correct about some topics. It's really important to budget. It's really important to understand what your finances are and what everything's happening. And in full disclosure, my wife and I went through financial peace, and it made a big difference in our life. But I actually think that he might even be right about avoiding personal leverage, right? Credit card debt, even maybe a mortgage on your own house, unless you're using a credit line to buy and flip assets or something. There's a significant amount of security that comes from having a debt-free lifestyle. And if you're not a person who has a tolerance for risk, then he's right about that too. There's some people that just they just want to have a pile of cash and that's all they want.
And I would even counsel take a balanced approach to both.
That's right.
Right? You know,
have some free and clear assets and have some leveraged assets.
Exactly. And one way to go about doing that is you can initially buy all of your assets on a leveraged basis, and it's like a test drive. You see which ones perform the best. The ones that perform the best, you might look at keeping super long term, and I mean way
and then
beyond
they
10
amortize
years.
over time.
You pay them down, you just keep them, and the ones that don't go maybe quite the way you want, etc., you sell those off, right?
Sure.
And then you buy more leverage assets, and you test drive them, and so you create two different baskets. You have your leveraged properties here, and your unleveraged ones here.
And my partner Travis up in Michigan, he is a big fan of that exact approach. Actually, he talks all the time about how he wants to
just don't ever collateralize.
Yeah, right. So he talks all the time about having a number of free and clear assets that are sort of his insurance policy against if everything goes bad. I know that these assets are safe.
The end of the world scenario.
Yeah. So I mean, if we deal with something like the Great Depression, something worse than 2008, if you have free and clear assets, you're still going to be okay. Like you might have less cash flow, but theoretically you're going to survive. So while Dave Ramsey isn't completely correct, I think he has some valid points, and I think that having a balanced approach, like you portrayed, is right.
Well, and the important thing is a lot of real estate advisors, and Ramsey's one of those, they offer good advice, but it doesn't mean you have to take it all verbatim and follow their approach exactly to the T.
That's right, and I think that's true of all financial advisors, not just real estate advisors. You see people like David Bach, who writes about the automatic millionaire guy, and he writes about how you should pay yourself first, and you should invest in your 401k. Personally, I think people should have 401ks, but I know real estate investors that are like, that is the worst investment ever because I have no control over it. And I think both sides have a valid point on that.
What I know is I'm out of old fashioned.
It's time to end the episode. So we appreciate it. Thank you for all your questions. And we'll do another question and answer session in the future. So feel free to send us questions on Facebook or just email me at jeff@oldfashionedrealestate.com or just, find us wherever you find us and ask us a question. We'll be happy to answer it.
We'll see you soon.
Thank you.
Bye.